Ladies and gentlemen, whenever we do these shows, I read all of Jeff's work, then I pick out a few that I think we should do, and then we go over it. And Jeff Snider, the head of global research for Alhambra Investments, this week said we're doing this one. So he's excited. He can't wait to share with you something about the System Open Market Account. Jeff, how can you be so excited about the System Open Market Account? We're going to be talking about a post on May 3rd at Alhambra Investment, and the title is SOMA's Been Talking for Over a Year. Jay's got some explaining to do. Bills.
Yeah, how can we be excited about something like that? Well, it's not really excitement as it is. Here we have more than a year's worth of data. We have a year's worth of Federal Reserve policy in action, and nobody talks about it. Nobody says anything about this. And we've talked about it before. We've kind of talked around the edges of it, how Treasury bills, collateral, Federal Reserve QE, all that stuff, especially the not QE, QE5, how that relates to it. But here we have a whole, I think it's not, what is it now, 14 and a half months where the Federal Reserve is basically saying, yeah, we kind of screwed this up. And this, as we were saying, this is not a small thing to have screwed up. So Jay does have some explaining to do, even though he would prefer that nobody know about any of these things.
No, I've previously said that I think it rises to the level of the legal standard of negligence and malpractice. We'll get to it. Let's go back in time now. System Open Market Account. You start out the article by taking us back to the very beginning to give us a reason why it's even there, and then another reason, the open market operation. So just, I don't know what a System Open Market Account is. Someone else probably doesn't either, Jeff. What is it? When did it come to be?
It's where it's essentially the 12 Federal Reserve branches portfolios. And the reason it came about was that when the Federal Reserve was first brought up as an idea, remember, it was not the first central bank in the U.S. history. It was actually the third. And the American people did not like central banks by and large. And so the last one had been banished, or its charter wasn't renewed back in 1836, I believe. So for 75 years, the American system, which experienced relatively awesome growth and innovation, all these good things, without a central bank, suddenly was being faced with the idea that it needed a central bank. Well, first of all, they didn't call it that. That's why it's called the Federal Reserve, even though every other central bank around the world is much more honest about its name. And secondly, what Congress demanded was, look, we know the central bank is not going to be popular, but we think we need it because JP Morgan said so. Therefore, it needs to support itself. The taxpayers are not going to stand for, another bloated bureaucracy that becomes, another mouth sucking on the taxpayer teat. So it needs to earn its own way, its own operations. And there are costs to, there's people have salaries, there's all sorts of infrastructure that needs to be done and things like that. And the only way a central bank can earn money is by investing in securities. Right? So it becomes an investable thing for these earned assets that the Fed needs, at least originally, in order to pay its own bills. And of course, that led to the accidental discovery that when the Fed buys bonds in order to pay its own bills, it seems to have an effect on the commercial banks and their behavior. And that's what became known as open market operations, which are OMOs. When the Federal Reserve buys bonds from the banking system, it gives them bank reserves in the offsetting transaction, the asset swap. What happens is the commercial banking system back then said, "Oh, I've got reserves. I don't have this bond. Let's engage in portfolio effects. I'm going to go out and buy. I'm going to do more risky stuff." So in the early days of the Federal Reserve, because of this earning asset requirement, the Federal Reserve, the entire system realized that they could affect, at least in the early days, bank behavior by engaging in this kind of operation, so that by the middle 1920s, it became more formalized in a part of monetary policy. You had first the precursors to the Federal Open Market Committee, which I forget the name of it, but then the Federal Open Market Committee, which I believe was reconstituted in 1923 or 24, and then this, what was called scissors effect, became an element of standard monetary policy practice.
Now let us fast forward to present day, and I was actually listening to a podcast, Mr. George Gammon's podcast, who's had some great shows lately. The one with Steve Keen, fantastic. Dear audience, listen to that one. And then the one with Brent Johnson, fantastic. And they were talking about monetizing the debt in Japan. was the example, and Europe as well. And Brent brought up the United States. And we're going to get to that right now. But Jeff, what is monetizing the debt? I think it means where the US Treasury says, I need to borrow some money, and the Federal Reserve says, okay, well, we'll give you some money. And it's like taking money from one pocket to the other, and then not actually, you don't actually have to ever pay it back. And so the concern is, well, this is going to be destroying the currency and the confidence in the currency. Let us start before the financial crisis. Did I get the monetizing the debt idea right? And then where was the Federal Reserve before the crisis? How much U.S. government debt did it have on its books that the government would, you could theoretically say, never kind of have to pay back or anything like that?
Yeah, I think most people, when they hear the word monetizing, that's pretty much, I mean, there might be some arguments about specific details, but it's not really, I mean, general idea is the government doesn't actually sell its debt. It has its central bank print currency, and then everything is just done out of thin air.
Intergovernment. Okay,
yeah, exactly.
Okay.
It's sort of a fiction that they go through the charade in order to maintain some semblance of reasonable standards. Quantitative easing has been accused of being monetizing the debt several times, even though that's, in some sense, maybe that's true. But if you look at the United States, the Federal Reserve, its SOMA holdings before 2008, I think I went back to 2003.
Yes.
Remember 2003 Bush deficits, there was complaints about government spending back then, and I think people would be shocked to learn that the SOMA holdings back then were more than 600 billion with a B. Back when 600 billion meant a lot. And in fact, even after the Bush deficits of his first term, the total U.S. public debt outstanding, and I know this doesn't include other liabilities, but public debt outstanding was a little bit over 6 trillion. So in fact, the Federal Reserve SOMA portfolios held about 10% of outstanding public debt in 2003. And there were no claims of monetizing. There were no shouts about all of this stuff. And the reason was because back then, people understood that the Federal Reserve has SOMA holdings. That's part of monetary policy. It has nothing to do with the debt. It has to do with their charade of trying to pretend they control the banking system, influence its behavior, open market operations, and those types of things. And it only became an issue under quantitative easing, even though quantitative easing is nothing more than a form of open market operation. The open market operations before 2008, before QE, were temporary open market operations, whereas those under quantitative easing become permanent, POMOs, permanent open market operations. And really all it does, it says, is we're buying more bonds and creating more bank reserves.
Yeah,
we're trying to influence bank behavior in a different kind of way.
We're going to be getting to the part that you're excited about with the SOMA portfolio, but let's just set the scene a little bit more with the size of the SOMA portfolio through each of the QEs. Jeff, I was surprised to learn that QE1 did not detonate that 10% number. We had to wait a little bit before the Fed was monetizing even more than it was in 2003.
Well, hey, the fiscal hawks are going to disagree with you there. The reason the Federal Reserve's holdings seemed to decline, they didn't decline, they actually increased, but the federal government's debt was increasing much faster than the Federal Reserve was buying. Now, what we would say is that, yeah, well, that's true, and interest rates were by and large low and falling. So even though the Fed didn't buy everything that the government was selling, the market was desperate for the stuff, and they definitely did want that. So yeah, in QE1, the proportion of the Fed's SOMA holdings as a percentage of the overall public debt fell, and it wasn't until later when the government stopped spending as much as it did, its deficits came back down, although they never did normalize to the pre-crisis era, while the Federal Reserve did more quantitative easing because neither of those things were actually working in the way they were intended.
And by the end of the fourth QE, which was in 2013, we were at 13.6%.
Oh, no, you're right. I'm sorry. They tapered in 2013, and they were terminated in December of 2014. You were correct.
13.6%. That's how high the proportion got. Okay, Jeff, help me segue now from monetizing the debt to really the meat of it, which is we're going to be talking about bills in October 2019.
Well, the idea is the other part of monetizing the debt has to be the money printing, right? Because that's what you're doing. You're printing currency in order for the government to spend freely without any constraint. But what if you're not actually printing currency? And that's really the part that we need to know. The purpose from the Federal Reserve's perspective has nothing to do with the Treasury Department's deficits. What Ben Bernanke and Janet Yellen or Jay Powell would tell you is that we need to increase the level of bank reserves because that's a signal to the financial community, to the real economy participants. As we talked about in an early show, what does quantitative easing actually do? It doesn't actually print any money. It just raises the level of bank reserves as the other side of a transaction, which is nothing more than an asset swap. An asset swap is the central bank goes to a commercial bank and says, I want to buy that government bond or MBS security from you, and I'm going to give you bank reserves in between. And the idea is, well, okay, that should help. Maybe people think that's a good thing. Maybe they think that's accommodative monetary policy, but it's not really money printing. Commercial banks know that. So even if it's not money printing, maybe there's no downside. At least they're doing something. It's a signal to the economy. Maybe it doesn't hurt. Except we have to appreciate that this asset swap has two sides. And the other side, the one side is bank reserves go up. And the other side is, well, now there's fewer bonds available for the commercial banking system. And maybe that's a problem. And it's not immediately apparent why that would be, because it sounds like we're just swapping assets out of a portfolio. But in reality, the way the modern system has worked for 50, 60, 70 years now, it's not so simple. Assets aren't just assets, they have other purposes. As I say often, especially sovereign bonds, they're balance sheet tools, and very, very valuable ones at certain times. And so you remove treasuries from the commercial banking system and give them bank reserves they can't really use, except to buy more treasuries directly from the government. They don't want the treasuries. They want the treasuries to be able to use in this massive, amorphous, ephemeral collateral pool for repo and derivative transactions that span the entire world. So it may be that quantitative easing that raises the level of bank reserves but lowers the level of bonds available to the banking system harms more than it helps.
Jeff, there are some people out there that are conspiratorial with the Federal Reserve. They say that the members of the FOMC are 7 feet tall and drink blood and can't be killed. You never say that, with one exception. And you didn't really say it either, but I remember reading this article specifically because of this sentence here. It's hard not to think sometimes that maybe the conspiracy theorists are onto something here. When you step back and you look at what they are doing, there are moments when you truly wonder if the authorities are actually trying to crash the system, at least to make a bad situation that much worse. And Jeff, you wrote that in October 2019, but unfortunately the people that run the show, they don't listen to you. Tell what happened.
It really is. If you were trying to do something, if you were trying to do whatever you could to harm the system, what would you have done differently than what Jay Powell did in that time period? And I can't come up with a single thing, other than to maybe to come out and admit the truth. But honestly, remember we had these repo rumble in September of 2019. It was a big deal. Nobody could figure out what it was. And Jay Powell's solution wasn't really a solution. It was, how do we get calm back into the so that the Wall Street Journal isn't talking about repo anymore? Well, they did what they always do. They raised the level of bank reserves. Now, they called it not quantitative easing because they wanted to distinguish between an easing policy and a technical, a portfolio kind of a maneuver. It wasn't meant to be stimulus. At least that's what Powell was trying to get across. And because it wasn't meant to be stimulus, he thought, well, how do we distinguish this from other quantitative easing? Well, the genius idea he came up with was we won't buy treasury notes and bonds because the public thinks if we buy long-term treasuries, that's stimulus, which is a ridiculous idea, but they're rationalizing at this point. So if we only buy treasury bills, the public will realize this is a technical operation, not a stimulus operation. Whatever. That was the justification. But in selecting only treasury bills to be bought for this, what really was QE5, he was actually making the biggest possible mistake. He was removing not just collateral, but the best of the best of the best collateral. And that's why I wrote that at the time. Like, look, this is going to come back to bite you, Jay. You're doing the exact wrong thing. And this is October 2019, when we just had a dress rehearsal in September of 2019 that said, if the going gets rough, the dealers are going to run for the exits. So they were already saying, any kind of shock, the system's fragile. And here you are going to make the system even more fragile at the worst possible time. Now, yes, it's true. Nobody could have anticipated COVID in October 2019, but that's not the point. The point was any shock would have propelled the system into what we saw in March of 2020. It didn't matter that it was COVID. It didn't matter that, yes, COVID was an enormous shock. We were going to have problems either way.
If you knew that you were in a depression, you would be expecting shocks. If you knew you were in the fourth turning, you knew that the shocks and the sparks that are going to come are going to have systemic consequences. And here you wrote, the whole bond market screams systemic collateral shortage, and these guys think, well, let's fix it by removing the best collateral from circulation. Can anyone in such a position really be that obtuse? It has to be on purpose, right? That was, again, October 2019. Let's fast forward.
You know, that's tongue-in-cheek. We don't really mean that they did this on purpose. What we're meaning is that their worldview is so backward, so ancient, and so out of date, they don't know what they're doing. I often say it's a 1960s view of the 1930s, and that's really how they are. We raise the level of bank reserves and everything is hunky-dory. Well, bank reserves don't mean the same thing to the modern wholesale system that they might have meant in 1929 and 1930. So raising the level of bank reserves, which may not have been that effective back then, has even less impact today. So what we're saying is, no, we don't believe that they're trying to crash the system. What we believe is they're so incompetent, they're so behind the times that they wouldn't know the difference.
Jeff.
And they didn't.
So from September until a certain week, they kept buying bills, kept pulling bills out, exclusively bills, sending reserves into the banking system to help the banking system. Jeff, what week did somebody print out that October 19th blog post of yours and place it in front of Jay Powell and on his desk? What week was it when they finally got the message?
They finally got the message the week of March 18th, which should ring a bell to a lot of people because that was the absolute worst parts of what we call GFC2, because it was a global financial, it was global liquidations and fire sales in every market, including treasuries. And so what happened on March 18th, it got so bad that the treasury market started to blow up. And it didn't just blow up, though. It blew up in a very specific way that they actually talked about a couple weeks later and wrote about in the minutes of their FOMC meeting, which said that even the on-the-run or the off-the-run market became illiquid and herded everybody into on-the-run. And on-the-run means the most liquid treasury instruments, which includes every single one of the treasury bills. So what they were saying, without knowing what they were saying and not knowing what the consequences or the implications of what they were seeing, was that exactly as I had said, they had stripped the one thing that the system would need most in an emergency from use, and it created this massive, it didn't create the bottleneck, it made the bottleneck that much worse. They contributed in all of the wrong ways to it going to the financial crisis in March 2020, going even worse than it ever needed to be. And they admitted it, but not explicitly. They admitted it by, from that point forward, what did they do? They stopped buying bills.
Right.
Now they've reinvested the proceeds of maturing bills, but what you see is since the week of March 18th and then the March 25th, they bought a little bit more in bills the next week, March 25th. But going back to March 25th of 2020, it's been the exact same balance ever since. So now for more than a year, the Federal Reserve has not touched the bill market through its quantitative easing, even though it has bought trillions in other types of U.S. Treasury assets. You would think that if bank reserves and this Treasury bill thing didn't matter, they would say, well, we need to buy anything. We got to buy stuff because we got to raise the level of bank reserves by a couple trillion. We got to buy bills too. And oh, by the way, what was the government selling off in April, May, June, July, and August of 2020?
Only
Not
bills,
bonds,
practically.
the notes. They were all bills. So the Federal Reserve was staying the hell out of the bill market and doing so in such obvious fashion. The only conclusion that you can come to is that it was purposeful. They refrained from buying more bills because here's where Jay needs to explain.
Say that last part again. They won't explain.
No, and he won't. But this is what the data says very clearly. At that specific time, the Federal Reserve, even these guys, they realized that buying bills was doing something harmful. And not only did they realize it was doing something harmful, they stuck to that realization for the entire time since, which is now more than a year. Today, or yesterday, Wednesday, the bill numbers, the SOMA holdings came out, and again, exact same number. They do not want to touch the Treasury bills other than reinvest the proceeds of what have been in there up until March of 2020. And this is what Jay Powell should be called. I mean, somebody should be asking the guy, hey, why aren't you touching Treasury bills? You seem to want to buy all the off-the-run bonds and notes out there, but there's an obvious, clear connection to the fact that the Federal Reserve is not buying Treasury bills and didn't buy Treasury bills when the government was selling trillions of them. So you are telling us by your actions that this Treasury bill policy was something wrong. Not something wrong, but something so wrong that you won't even do anything, won't touch it, even though here we are a year and a month later.
A couple of things. Wouldn't the right thing to do would be to now drain the SOMA of the bills and send them back out, stop reinvesting so that you're not taking any more than necessary out? And two, I'm reminded of that paper that the Federal Reserve researchers wrote in December of 2020. And I wonder if, Collateral is gaining prominence in the Federal Reserve discussions, and they're realizing how important the Collateral is to the system. What do you think?
The second part, that I think is somewhat true, and there may be a growing realization, and there's a growing, it's tiny, but it's a growing volume of scholarship and evidence that suggests that's the case. What we've been saying, that quantitative easing strips the system of necessary collateral, but that doesn't necessarily mean that monetary policy is going to reform itself overnight into incorporating that fact into the way it operates, because it's, first of all, this is a bureaucracy, and second of all, I don't think they realize the full implications of that. Because once you do that, you say, well, collateral may be more important than bank reserves. As the paper said, if you want more stability in the financial system, shrink the Fed's balance sheet. They're nowhere near ready to appreciate the full weight of those implications, nor are they ready to do anything about it. So they may say, well, yeah, there's something important in collateral, but it's not going to be a primary consideration because they do things the way they do things, and they don't really know how to do anything else. And it'll be a long time before we get to a position where they do appreciate the full length of collateral, and that's, who knows what'll happen in between. But to your first question about why don't they let the bills drain off, there's technical reasons why they want bills in the SOMA portfolio, including the reverse repo program, which we don't need to get into here because that's another tangent. But there's justifications that they could have for saying, well, we need to keep it at the same level even if we don't go above. Okay. Which just still comes to the same conclusion, which is they say, they know by their own actions, you can tell by their own actions, their own data, they know they screwed up big with the bills.
What was I going to say? I've already forgotten. I thought it was going to be really good. Well, I think we've got all our final thoughts. Is there anything else that we wanted to say, Jeff?
No, it's just, again, it's, we're in the process where this stuff is, the evidence is so overwhelming that it's hard to come to any other conclusion. But the problem with that is it takes, it's hard to penetrate a bureaucracy. But more than that, as I said in the title of this piece, Jay Powell should be held to account here. Somebody in the media should be knocking on his door saying, look, man, your own portfolio actions dictate that you did something wrong. Explain yourself, person. And we all know that's never going to happen. Well,
you've got some contacts in the media, and I'm sure there's some people in the media that watch and listen to this show. It could happen. Jeff, what I was thinking? It would have been wonderful if they had spent that 18 to 20 months that they did reviewing their inflation policy and holding all those conferences and Fed meets, if they had done it on collateral. I wonder where we would be. That's a alternate universe.
Thing about that is, Emil, if they had done that they would have realized that that would have solved their inflation problem too. So it wasn't like it was completely off topic. They just don't realize it's on topic.
Let's move on to part 3 of the show.